Hey, welcome back to the channel. So today I'm going to be looking at Huami, which is a company that specializes in developing smartwatches, and they're a company that I really like as a value play over the next few years. And in this video, I'll be going over some of the valuation metrics that led me to deciding that they're a good company to invest in over the long term. So Huami is a subsidiary of Xiaomi, which is a larger tech company in China. They're known as being the fourth company to self-develop mobile phone chip capabilities, meaning they make their phone chips in-house, which has been accomplished previously by Apple, Samsung, and Huawei. So they're in pretty good company there. Xiaomi isn't listed on the American stock exchanges, so if you're a Canadian or American that would like to invest in them and you don't want to have to invest in the Chinese stock exchanges, then you'll have to do that through a subsidiary, which is Huami, and the focus of the video for today. So Huami is a company that specializes in smartwatches, and I have some of their products on the screen right now. So they have a lot of really cool watches actually, and they come in at a very low price compared to what else is on the market. And with these watches, you're able to do many of the things that the other watches are capable of. You're able to track things such as your steps, calories burned, sleep tracking, heart rate, and many more. So I think the quality is there, and the price is attractive enough that more and more people will start buying their watches. So I first found Huami while going through a stock screener on SimplyWall. I inputted the things that I'm looking for, and Huami showed up as one of the best matches. So I started looking more closely at the company and what they're all about, and I really like the valuation for them. So as it stands right now, a share is about $12.40, and they have a market cap of just over 750 million. So they're definitely a small cap stock, which indicates that there may be quite a bit more of upside depending on how big you think the company is going to be. So getting into the valuation metrics, there are quite a few things that I look for just to start my evaluations. So I'm looking at PE, which is price to earnings. For PE, the price to book value, the price to sales, price to earnings growth, and estimated earnings per share growth for the next year. So I'm using Yahoo Finance for this portion of the video, and right away we can look at their trailing PE, which is just under 11. Personally, for companies that I invest in, I think a PE of under 30 is generally a starting point. If it's higher than 30, then it's got to be like a really high growth company at that point. For value companies, you want the price to earnings to be lower so that it's more of a value play. The 4 PE generally should be about 20 or lower in my opinion, and here we're looking at a PE of just over 12, so that's excellent. Next is the price to earnings growth, which doesn't show up in Yahoo Finance, so we won't be looking at that for this company per se. But in general, you want a PEG of at least 2. Next, we go to the price to sales, which generally I'd want it to be under 2, and right now it's just over 1, so that's great. And then finally, the price to book, which is the price to assets minus liabilities. And generally you want that ratio to be less than 3. And we're just above 2 right now, and that's for the most recent quarter. So in all of those valuation metrics, I think Huami is a really good choice as it passes all of my requirements. So next, I'm going to go to the next page, and we're looking at the income statement. So this shows the income statements for each of the past 4 years. And as you can see, total revenue has been growing quite a bit year over year. In 2016, they had just about $1.5 billion in sales. And for the most recent year, they're up to almost $6 billion. So quite a good amount of growth there. And this is also reflected in the net income. So 4 years ago, they had just under $24 million in net income, and now they're up over $575 million. So not only are they growing revenue, they're also increasing profitability and bringing in more money to the company each and every year. So that's really all that I look for in here, since it doesn't really matter initially what the costs are. That's something that I would look at later on after I decide whether this is a good company to invest in. Maybe you look at where the expenses are going. Is it operational? Is it one-time things? Where are they losing money? But initially, you kind of want to see that growth in revenue and a growth in net income. So this last page on Yahoo Finance, I brought up just to look at the growth estimates. So ideally, I'd want an EPS growth of 5% for the next year. And with these estimates, they're expecting a 22% growth for the next year. So that's also really good. So as it stands right now, Huami is meeting all of the requirements that I look for. And the final check into the initial stock evaluation is looking at the balance sheet. So this currently is still performance. I've switched over to Simply Wall now, and usually I use the balance sheet on Yahoo Finance, but for video purposes, I think the Simply Wall visualizations are really good to help explain things. So before we get to the actual balance sheet portion of this website, I just wanted to reiterate, kind of show you the earnings history. So as I said previously, the revenue and earnings of this company has been growing a lot year over year. And this graph does a really good job at showing that. So the increase has actually become steeper over time, which means they're growing at a quicker rate than they have been previously, which is excellent. And if you compare the company's past growth over the past 5 years and previous year, compared to the industry and the market, they've been destroying other companies in terms of growth, which is excellent. So finally, we're going to get to the balance sheet portion of this website. Generally, what I want to see is the assets being able to cover the short-term and long-term liabilities. And in this case, they're definitely able to do that. They have the capability of covering all of their liabilities that they have on their balance sheet as it stands. And they also don't have any debt on their balance sheet, which is amazing. So that removes a little bit more risk. So Huami, in my eyes, is a very good company to look at as a long-term value play. And not only are they undervalued in my opinion, but they're still a small cap stock, which leaves them a lot of upside if you think the company can be a mid-cap stock or even a large cap eventually. So Huami is one company that I really like and that I'll be continuing to watch in the future. And to sum up, the things that I look for in valuing companies are the PE, which should be under 30, forward PE of under 20, price to book of under 3, price to sales of under 2, price to earnings growth of under 2, and an EPS growth for next year of at least 5%. So that's today's video. Let me know if you like it. Remember to subscribe and like. Leave a comment telling me anything you'd like to see in the future. And until then, I'll see you next time.